Welcome everyone, my name is Vishal Tekshanani. I am a senior editor here at Livewire Markets, and I'm really thrilled about this episode because you are going to learn where the best investment property returns have been in Australia over the past 20 years as far as cities go. So this is a piece of research that we've done with Cotality Australia, formerly known as CoreLogic, who are the experts at everything property data related. Now I've got the cheat sheet in front of me, and which cities and what's performed best has absolutely shocked me, and I'm sure it'll shock some of you too. So I'll be joined by Tim Lawless, who's the head of research at Cotality, in a moment. Tim will share the results with me, and we'll also talk about elements like houses versus units, what performed better. Again, the results across some cities will surprise you. We're going to talk about the lessons of property market investing over the past 20 years, and we're also going to look at the future of the property market and what we can expect given where prices are today. So really excited about this interview. Now, the conversation I'm having with Tim is immediately before we publish the Livewire long-term investing report for 2025. If you haven't seen that, please head to the description below and click on the link there, because that report will show you how residential investment property did among major asset classes. And I'm also going to quiz Tim to see if he knows how resi property did against shares, commodities, fixed income, and see if he can also guess the top performing asset class over the past 20 years. So without further ado, Tim, thank you so much for your time. Great to have you here.
It's an absolute pleasure to be here as well, and thanks so much for the invitation. I follow Livewire all the time, and it's a real treat to be part of the program.
Okay, well, we really appreciate your readership. So, Tim, the first thing our readers are going to ask is, okay, how did Cotality calculate this data? We're looking at resi investment property in particular. Can you walk us through the methodology of how you calculate total returns?
Yeah, absolutely. So we're using an accumulation index here. Most readers should be familiar with the way we calculate value change over time, which is a hedonic regression index. We look at imputing values across every property across the country, regardless of whether they sell or not. And the sort of things we look for to estimate that value will be, the attributes of the property, number of bedrooms, number of bathrooms, the land area, the surrounding proximate sales, of course, are really important to get an understanding of what the comparable value is. So it's very much a compositionally and quality adjusted portfolio to measure values over time. And then, of course, in the accumulation index, we're also adding in reinvested annualized gross rental yields as well. That gives you a bit of an idea of the sort of, I suppose, income coming in off the asset class, and theorizing that we're reinvesting that back into the portfolio. So overall, as you say, it's a total return index. We generally utilize our total return index to compare against other asset classes, particularly, say, the S&P accumulation index, for example.
Okay, so it's like with Aussie shares, dividends reinvested, but property, the cash flow is reinvested.
That's exactly right.
Okay, all right, makes sense. So without further ado, last 20 years, Tim, where have been the best performing cities in Australia for an investment property?
As you sort of introed, it might be a little bit of a surprise. Like the national number, just to start really high level, national dwellings are up about 498% as a total return over that 20-year period. But the strongest market's actually been Adelaide, right? So if anybody is not familiar with Adelaide, it's our fifth smallest or fifth largest capital city in Australia. It's the capital of South Australia. So it's a relatively small market, and it's seen in terms of the 20-year change about a 560% growth rate, including the total return. So stronger than the national average, but of course it's been a market that's been more volatile than other regions as well. And that's probably I think that the lesson here is that while we see some relative volatility in, say, the benchmark indices, some of the smaller cities like in Adelaide, or for that matter, Hobart or Darwin, they do see a lot more volatility and quite extreme cycles over time that have really influenced that number.
Okay, so Adelaide in general has the best performing dwellings?
Yeah, that's right. So Adelaide, 560%. They can go to Brisbane, 545% total return over that 20-year period. And then Perth, 487% roughly as well. So there's really iconic cities like Sydney and Melbourne. They've shown pretty strong returns as well, but not quite as strong as those mid-sized capitals.
Okay, so gold to Adelaide, silver to Brisbane, bronze to Perth over the past 20 years. When we think about these cities, I think from a property investment perspective, there's so much fixation on Sydney. It's the global mega city. Theoretically, it should have the best performance because of high wages and a very, very strong economy that draws so much global capital. But why has the performance across Adelaide, Brisbane, and Perth been so strong to the extent that it's actually outperformed Sydney?
Yeah, well, I think Sydney, to some extent, affordability is starting to get into the way of that marketplace. It is an extraordinarily expensive market. You've got a median house value at the moment that's above the $1.5 million mark. So I think that's part of the reason we've seen the rate of growth in Sydney underperforming. These mid-sized capitals have moved upwards from a lower base, is probably another reason. But when you look at the cycles over time, there are some examples of really extreme phases of growth. Using Perth as maybe the most obvious example, the mining boom. Perth is a really sort of resources and infrastructure intensive capital city, the capital of Western Australia. And it's gone through some extraordinary cycles, particularly say between 2006 and 2014. As part of the mining boom, really the mining related infrastructure boom we had here in Australia, that drove housing prices remarkably, doubling in the space of 5 years at one stage. And again, it's a very strong market at the moment, pretty much since 2020, rising from quite a low base. So I think that's probably one of the biggest factors here is just that cyclicality over that 20-year period has moved through some extremes, both from a high point and also from a low point as well.
What are the different cycles in the property markets over that 20-year period tell you about the lessons as far as, cities can go from being weak performers to being very strong performers over a period of time?
It's a great example, and Brisbane is one of the strongest markets at the moment based on the 5-yearly growth rate, but also the past 20 years. But that period between, say, 2010 and pretty much 2017 or even 2019 was a very quiet one for Brisbane. It had seen a real slowdown in interstate migration, which in Australia, the interstate migration rate, which is people moving from one state to another, or that net interstate migration rate, is a really important factor for purchasing demand, not necessarily rental demand, but absolutely for purchasing demand. And Brisbane, or Southeast Queensland for that matter, was going through a bit of a lull in its rate of interstate migration. It had also seen a pretty decent supply response, especially in the apartment market that peaked around 2019. And that lackluster performance across the apartment sector really weighed on Brisbane's overall performance. In fact, even though the Brisbane unit market now is very strong, it hasn't really seen a great deal of new supply being added to the marketplace. There's a lot of investment activity. It took a long time for that market to get over the hangover of a substantial supply increase. And that's probably another, real highlight of the cycles we go through in Australia. We tend to move through periods of undersupply and oversupply in the housing markets, especially in the unit sector. That tends to have a fairly big impact on the headline growth numbers.
Okay. And you raised such a great point about units. I'm looking at the data here, and single-handedly, if the best performing asset class within property has actually been Adelaide units with a 604% return. And we talk about there's this perception in the property market where it's like, don't buy condos, don't buy apartments, they don't grow in value. But you're actually seeing very, very, very strong 10, 15, 20-year returns in Australian apartments. Like, why is that happening? And what would you say about, what would you say to those people having a perception that apartments make a bad investment?
It depends on what sort of investor you are and what sort of return you're looking for. I think part of the reason we're seeing a stronger return in the apartment market, at least stronger than what some might have expected, is the yield profile is generally a lot higher. So if you look at typical yields across Australia, the average yield across all dwellings is about 3.7%. Units tend to be about a percentage point higher, houses about a percentage point lower. So there's been a more of a contribution from cash flow, I suppose, or at least rental income coming from the apartment sector. But also an apartment market like Adelaide is a really, or at least it was, a really immature one. The vast majority of homes in a city like Adelaide and Perth, for that matter, are generally really low density. And it's only as we start to see affordability challenges are becoming more prolific and town planning starting to evolve that we do start to see more supply coming into the market. So in the case of Adelaide, I think that really strong return from the apartment sector is both from it's coming from a low base, it's got a higher rental yield on that total return calculation, but also it's a market where units are generally, well, they have had a fairly intense scarcity value to them as well. I think that'll change over time. We're definitely starting to see some of these smaller cities like Adelaide and Perth becoming a little bit more mature in their densification path. But a market like Perth is a really good example of a city that's kind of adopted this LA style urban sprawl, spreading north and south of Perth without really densifying too much. And we're finally starting to see a lot more focus from town planners and policymakers to really try to get more density into that marketplace, partly in an effort to combat affordability.
Okay, so just want to hone in on that a bit more. So, given high property prices, especially for detached home, and a pipeline that's increasingly upwards rather than outwards, Min's government, etc., trying to build everything as close to public transit as possible. How should investors think about units as a long-term investment option, given, especially for newer property investors, that's probably the price point which they can afford?
Yeah, I think there's a couple of ways to look at this, and I absolutely agree with you that the way to go is up in terms of vertical living. If you compare even a really mature density market like Sydney, density tends to be really clustered, in the CBD, in Parramatta, in Chatswood, North Ryde, Olympic Park. There's real clusters of densification, but beyond that densification really isn't broad spread. I think we're on the cusp now of starting to see a lot more infill development along the transport spine. So a really good example would be along the metro, which extends from say around the CBD and inner west out to the outer northwestern suburbs um, around say the Hills district. So absolutely, we're going to be seeing a lot of densification along those transport spines. Governments really want to leverage the capital investment they've made on transport to get larger populations utilizing and leveraging that capital investment. But for an investor, that doesn't necessarily mean that's where the best capital gains are going to be. I would probably argue that it's the underlying land scarcity of a detached home that probably will continue to deliver the strongest capital gains. Maybe not the strongest rental returns, but definitely I would argue definitely the strongest capital gains. If I was an investor looking to buy into the apartment sector, I'd probably be a little bit wary of the high rise market. That tends to be where supply can be really lumpy and really quite volatile. And if you look at the highest density markets around the country, they're markets where we've hardly seen any capital gain. Melbourne CBD or South Bank or Docklands are probably the best examples, or even Parramatta in Sydney. You're still buying apartments in those markets that really haven't moved very much, even maybe backwards from their off the plan purchasing prices. So I think trying to focus on more of a medium density market for an investor is probably a much better investment option rather than buying into the off the plan high rise sector where I think just supply additions and that volatility of supply can be a real hindrance to longer term capital growth.
Yeah, wow. Lower prices than buying off the plan. That's a long time spent waiting for negative returns. So, detached homes, townhouses, and I guess with apartments being selective, quality boutique units in terms of um, the best ideas for investing.
Yeah, some really good examples. Back to the previous apartment boom we saw here in Australia that was very much Melbourne, Sydney, and Brisbane centric. There's still some really chronic examples of just a loss of quality where the certification process went in-house and a lot of private certification resulted in buildings that just weren't up to scratch, and some really high-profile examples of buildings that had to be evacuated because of the quality of the construction just simply wasn't livable after a while. So yeah, I'd certainly recommend looking at the track record of builders, the quality of construction, making sure you get private inspections before purchasing as well.
Yeah, no, that's some great tips there. Okay, we don't want to leave our friends in regional Australia out. So as far as regional centres go, Tim, what have been the standout performers?
Yeah, well, overall, regional markets did see a total return of about 502% over the past 20 years, but the strongest markets have generally been those that are peripheral to the capital cities. You've got one outlier, that's southeast Tasmania, which is sort of just to the southeast of Hobart. That's where we've seen housing values up about 210% over the past 20 years. But generally, sorry, that's just in the capital gain. I'm not including the rental return or the I simply didn't have those numbers in front of me. But if you look at the strongest capital gains outside of that southeastern Tasmanian market, you've got markets like Newcastle, for example, 170% growth in values over the past 20 years. Then you've got Illawarra comes in third on the list. And then Toowoomba, which is just outside of to the west of Brisbane as well. So there really does seem to be a trend of the markets that are somewhat commutable back into the major capital cities are quite high on the list. You've also got the Gold Coast and the Sunshine Coast pretty short after that, which really demonstrates this fascination with proximity to water in Australia is still really important. And even just through the pandemic period, we've really seen this attraction to lifestyle and commutability remaining quite a key factor driving growth in markets. I mean, even international listeners probably know of, say, Byron Bay, for example. It's a market that's absolutely just boomed since 2020 and has the benefit of being commutable back to Brisbane. It's got a pretty decent airport on the Gold Coast and in Ballina, and it's got this amazing lifestyle and coastal environment.
Yep, as someone who's traveled across North America, your first question get is, "Oh, Byron Bay. Have you been to Byron Bay? It's such a beautiful part of the world." Okay, so Tim, you make some great points about those cities on the periphery experiencing some strong growth. So, what's your view on the next 20 years, particularly when you have a lot of commentary and concern around can Sydney property in particular and Brisbane and Perth increasingly keep going at the rate they're going, given you have detached homes averaging upwards of $1 million and across Australia? Where's the growth going to be?
It's such a hard question to answer, and I think logically, I'd find it very difficult to see that the past 20 years' growth being replicated over the next 20 years. It's just moving from such a higher base. Affordability was a lot more practical, say 20 years ago. We're now in an environment where the dwelling value to income ratio nationally in Australia in the middle of this year was about 8 times. It would have increased further since then as well. Markets like Sydney have a dwelling value to income ratio that's around 10 times. So it's hard to see a similar rate of growth being evident in the marketplace over the next 20 years. We probably also won't have the benefit of interest rates structurally moving lower as well, even though they're above average at the moment. I don't think we're going to have that really long run where interest rates are going to be supporting, or lower interest rates are going to be supporting value growth either. So I think trying to pick the markets that are going to be strategic enough to outperform the broader average is going to be the name of the game. And as I mentioned a bit earlier on, I think detached homes probably still have the benefit of that underlying scarcity, even though we're such a massive country. Our population tends to be really heavily clustered along the eastern seaboard, particularly in three major capital cities, Melbourne, Sydney, and Brisbane. So I think buying into those markets where we're likely to see just that critical mass and underlying scarcity is probably going to be the key factor driving growth, even though these are markets that are generally more unaffordable. If I was to pick one of those markets, I think Melbourne is probably the obvious one. Melbourne's had a pretty soft performance over the past 5 years or so. It's substantially underperformed Sydney and Brisbane. It's got a real affordability advantage. The dwelling value to income ratio in Melbourne's more like around 6 times. So it's quite a bit lower than Sydney. And in fact, we haven't seen the gap between Sydney prices and Melbourne prices this wide since about 1999. To give you some context on just how far Sydney's removed itself from what's generally a fairly closely pegged relationship with Melbourne. So I think Melbourne probably does have a stronger prospect for capital gains, at least over the medium term. Going out the next 20 years, I'd certainly hesitate to try and predict where the market's going to be. And by then, you'd have to think there's going to be more demand just radiating further out from the city as hybrid working situations and technology does what it does. You'll probably find we do see some gradual and or demand gradually rippling a little bit further afield as buyers and investors look for that combination of affordability and livability.
Okay, so Melbourne's the top pick despite the recent tax increases that are affecting homeowners there.
Yeah, I mean the tax increases in Melbourne are mostly a lower land tax threshold, so that dropped from 300,000 to 50,000. So it's not necessarily a higher tax base from a land tax perspective. It's got a much broader net that catches a lot more investors now. You got a 50,000 threshold in Victoria to pay land tax in Sydney. It's more than $1 million before you're paying land tax in your underlying land holdings. So, and there's higher rates of stamp duty as well, but generally investors tend to overlook that the transactional costs. They focus very much on opportunities for capital gain, which I think Melbourne, given it's the second largest capital city and it's got such an affordability advantage at the moment, that's probably going to shine through.
Okay, makes sense. Before we go to the quiz, Tim, I'd love to hear your view in particular, property versus shares, which is a huge conundrum for our audience in particular. Lots of them do have investment properties. Lots of them, religiously believe, I don't want the pain, I don't want the hassle. Equities with the franking credits should do better over time anyway. What's your view on the debate?
It's an ongoing debate, that's for sure. And when I put the two asset classes side by side, which I do every now and then, using an accumulation index like this, they generally tend to show a fairly similar performance over time. The only thing is equities tend to show a lot more volatility than houses, or housing markets tend to have much smoother cycles. But over time, that volatility or lack of tends to smooth out. Also, I mean, housing, it simply doesn't have the same liquidity, of course, as equities markets, which is really attracted to a lot of buyers or investors. Transactional costs tend to be really high in housing markets as well, but it's a pretty mainstream investment vehicle for Australians. It's relatively simple. Any changes in the taxation environment, like property negative gearing or capital gains tax concessions, I think would have a profound effect on housing investment here in Australia as well. But overall, I think having a diversified portfolio is the way to go. That the liquidity challenges of housing are definitely going to be a turnoff for a lot of people, but the demonstrated and low maintenance sort of hold, I think, for housing is still quite appealing and very mainstream for Australia.
Okay. No, great points there. All right, Tim, it is time for the quiz. Okay, we're going to get you to give your take on the Livewire long-term investing report. Okay, so what I did for this, Tim, was I looked at, with my team at Livewire, Kerry Sun at Livewire, we looked at the 7 major asset classes of interest to Australian investors. We didn't count Bitcoin, it's too new, it's too underallocated. We looked at the core things, okay? So we looked at Australian shares, US shares, bonds, gold, cash, and listed property, or A-REITs as well. So I want to ask you, over the last 20 years, out of those 7, where do you think Resi investment property ranked? We took your data for this.
I'd probably say gold. Just given the fact that it's been on a bit of a growth run and had some pretty strong cycles. I think property and equities are probably, like I said, going to show a reasonably similar performance. But yeah, I did something on gold versus property a year or so ago, and gold had a pretty decent margin that it built up. So yeah, I'll put my money on gold.
Well, mate, you are right on the money. So gold has been the top performing major asset class over the past 20 years with an annualized return of 10.74%. That's annualized. US shares second at 10.53%. Now, property actually edged out Australian shares comfortably. Okay, so Resi property, using the hedonic All Australia Total Return Index, 9.13% per annum. That's nearly 2%, 2 percentage points above Australian shares. When you compound that over a 20-year period, it's actually investment property, which has very comfortably beaten domestic shares. And, I just feel like Australian shares, they have been, this year in particular, quite the underperform in a global context. Whereas the property market here has maintained its resilience as far as demand and growth goes.
There you go. Glad I got the quiz right.
There you go. Your mental mapping of how asset classes are performing are very sharp. So, Tim, we really want to thank your team for the data. Really appreciate your time and insights on the property market.
Many thanks, and yeah, it was an absolute pleasure to be involved, and look forward to seeing the further work from Livewire. Cheers.
I hope you enjoyed this interview. Thank you so much for subscribing to our channel. Don't forget to like this video as well. Hope you learned a lot about where property market returns have come from, and with Tim insights as well, the direction of where future returns could come for. Stay tuned for more great insights.